Hello friends, hope you're doing well. Chris Lee, CPA here, back with another video for you. And today we are going to talk about some alternative strategies for, real estate, appreciated real estate and exiting that real estate without a 1031. So how do we manage tax consequences strategically without a 1031 if there are certain reasons that we want to avoid that? And so, we're going to have three different kind of options to talk about in managing these taxes, ranging from like more complicated to less complicated. So first idea that we're going to talk about today is this idea of using a combination of a charitable remainder trust and wealth replacement trusts. Okay, so a charitable, before we talk about how this kind of works and the steps and the benefits, we first need to understand what a charitable remainder trust is. So first, in the world of trusts, there are two types of charitable trusts in general. There's a charitable remainder trust, and then there is a charitable income trust. So when we talk about the charitable remainder trust, what that is to say is that you donate assets to a trust, and the trust will hold those assets until the beneficiary dies. And so what happens with those assets is that the income generated of the assets in the trust actually get distributed out to the beneficiaries. So it could even be the people that created the trust. And then once the beneficiaries pass, the remainder of the trust assets actually are deducted, are distributed to charities. Okay, so that's the charitable remainder trust. And then there's the charitable annuity trust, and so that's basically where the charitable organization gets the benefit of the trust during the lifetime of the the trust sponsor, the grantor or whatever. And then once the beneficiary passes, then you get the benefit to the heirs. Okay, so that's when the assets pass on to the heirs. So the charity gets the benefit during the life of the sponsor of the trust, and then once they die, then the heirs will take assets of it. So that's the first thing we kind of need to know about that. And then a wealth replacement trust is usually kind of a trust that holds a life insurance policy that functionally is to get an asset out of to keep life insurance policies out of an estate that might otherwise be taxable. So we separate the two. It's an irrevocable trust. And so what we can do is we can use a combination of a charitable remainder trust and wealth replacement trust. So what you would do is, rather than sell your real estate outright, you would first contribute the real estate to a charitable remainder trust under terms that grant you and your spouse, as applicable, the income from the trust, either on a fixed income or a percentage of the trust income during your lifetime. So you and your spouse will receive income from the trust when you donate the property. So when the property goes into the trust, a couple things can happen. One, it can be a rental asset, a rental property that generates cash flow that then is distributed out to the beneficiaries. Or two, the trust itself could sell the asset and use those funds and invest in some sort of more liquid investment opportunity. But either way, the trust assets, the income stream from it, flows to the people that sponsor the trust. So you first will donate this asset to the trust, and in the trust grant you and your spouse income from the trust, either on a fixed income or percentage of trust income during your lifetimes. The next step will be that you'll stipulate that the trust, that the remaining balance of the trust when the second spouse dies is going to go to the designated charities of the trust. So when you form the trust, you'll designate the charities. It's important to remember that these are largely, irrevocable trusts. So what you can change is like very little. That's how we avoid all the estate tax consequences when it comes to trusts. Is the more control you have, the less benefit that you're going to have in these trusts from an estate tax perspective. So when you put these assets in, you'll grant yourself the income from the trust, and then you'll also stipulate that the remainder of the trust that's to go to charities does not pass to the charities until the second spouse dies. So the benefit of this kind of structure is that the cash, rather than paying tax, and then the interesting thing about this is that when you create these trusts and you put assets into them, you get a tax deduction on the front end. Okay, we'll talk a little bit more about that in a second. But the benefit of this is that rather than selling off the asset, paying taxes potentially, and then making the charitable donation, you really avoid that tax consequence, right? Because once you put it in, you get the deduction for putting it into the charity, and then the gain gets triggered within the trust. And so then we have obviously different consequences to think through, but we're transferring the results of that to the trust. Now you can, so you get the cash, the opportunity to diversify it without, the income tax consequence, and then you can create a charitable contribution deduction immediately. So one thing to note is that when you make contributions to these trusts, charitable contribution deductions are subject to various percentages based on your adjusted gross income and the type of the depending on the type of the contribution, and also the all sorts of factors. So if you become limited because of this, you do have carryover regimes that allow for 5 years carryover for excess charitable contributions that were limited, and so you can carry them forward. And then it's important to note that when you donate assets to a charitable trust, your charitable deduction is based on the present value of the remainder interest you donate to the charity. So you basically are going to do a math project to determine what's the value that the charity is going to get when the second spouse dies, and then that you basically state it in today's dollars, do it in a present value calculation, and that becomes the charitable contribution deduction for the year of the donation. So next, you will then create a wealth replacement trust, and what you will use is funds that you receive from the charitable remainder trust during the income from that trust. You'll use those funds to fund a wealth replacement trust, which is a life insurance trust that uses term life insurance with a second to die policy that insures both the husband and the wife. So the insurance trust is, in this scenario, the trust is the applicant for the insurance policy, the owner of the insurance policy, and the payer of the insurance premiums. Okay, so that you've got the trust is basically everything to do with the insurance policy. So when the surviving spouse dies, the insurance company pays the death proceeds to the insurance trust, and then those trusts proceeds from the insurance policy is passed to passes those proceeds on to the heirs of the trust. So that creates the cash benefit that you would hope that your heirs would receive. So you use some of the income stream from the charitable trust to fund a wealth replacement trust, and then at the end of when the spouse passes, you will then have cash to pass to your heirs via the trust. So the insurance is kind of like a have your cake and eat it too part of the strategy. So without the insurance component, your heirs aren't going to get anything because you put it into a charitable trust, and everything left over is going to go to charity. With the insurance, you might give them as much or more than you would without the charitable remainder trust. And then the big benefit of the life insurance proceeds is that that they're usually not subject to income tax. And so it's just really important to, this is a creative strategy. This is definitely on the creative side. It is not meant for everyone. So this is something we would think about with people that have an estate tax problem, that have, both a need and a capacity for something so complex that takes, a financial advisor, an attorney, a CPA that understands this stuff to be able to execute this for you. And so this is definitely not like the off-the-shelf sort of policies. You definitely you think of this, tailor this very individually. So one thing that happens with this, though, when you're talking about wealth replacement trusts, is you really need to remember that you and your spouse must be insurable for this to work. So if only one is insurable, that's fine. It's usually just less effective. You want both to be insurable, though, to really get the benefit out of it. Primary benefits, though, of combining the charitable remainder and wealth replacement trust strategy, excuse me, is no capital gains. There's going to be no capital gain taxes on the property transferred to the charitable remainder trust. The higher income, you get a higher income stream because you invest pre-tax value, not post-tax value, into the trust. You generally get a decent sized charitable deduction. You get income to pay for the life insurance policy, cash for your heirs as if you gave nothing or little to charity, right? Because the cash, the policy is paying out to the wealth replacement trust. And really, you've now also created a benefit to a charity, which is great for them. So, yeah, good strategy, complicated to implement. So it's important that when we do these sorts of things that we talk about them. We go in eyes wide open because you can't really unravel this really easily once you put it in place. So everyone kind of needs like very informed consent for what they're about to do when it comes to these types of things. So the second option is gonna rely on, rather than us transferring it to a charitable organization, we're going to use a provision of the partnership code sections to exchange our property for one type of asset for another, rather than doing a sale transaction. So when it comes to Section 121 and partnerships, it basically says you can contribute property to a partnership in return for partnership interest without recognizing gain or loss. Now, there are elements of this where there can be gain or loss, particularly if the property is mortgaged and it has, basically you're underwater in the property from a basis perspective. Your adjusted basis in the property is, upside down basically. But what this does do, though, when we say that there's no gain or loss, Section 1721 includes that property can be transferred to an operating partnership of a real estate investment trust or a REIT. REITs are public, can be publicly traded, so they're treated as securities, and so you can contribute your asset to an operating partnership that's sponsored by a REIT, and change that property from a individually held investment in real estate into interests in an operating partnership of a REIT. And so what that entitles you to is periodic distributions from the real estate investment trust. And then the additional thing is that rather than it just being keeping those operating partnership units of the trust, you can actually convert them to units of the actual REIT itself, and then get an even broader base exposure than just at the operating partnership level. So the REIT investments can not only avoid taxes on the transfer, but they'll also provide liquidity. Like I said, a lot of REITs are publicly traded, and so you can, when you've got a publicly traded REIT, that means you've got options, you got greater liquidity, and then less transaction costs, right? So, excuse me, when it comes to real estate, we've got the biggest issue being that the transaction costs are so high on exiting. And so if we can execute transactions that avoid taxes without having to trigger those sorts of consequences, that's a better answer. So this transfer to a special kind of REIT can solve the problem that triggers tax on property transferred with a mortgage liability when there's, a property has a mortgage liability in excess of its basis. So with the excess mortgage, you usually would recognize gain, like I said, but the special REIT, there's a special type of REIT called an UPREIT that basically says they will guarantee an equivalent portion of the liabilities of the REIT. So as basically makes that excess mortgage basis issue go away. So it's kind of complicated how it all works on the UPREIT side of the provisions that solve that problem. But in general, just know that you could look at contributing your property to a REIT in exchange for operating partnership units, and then potentially transform those even into specifically REIT units. So the third option is one that's like more commonly discussed is the installment sale. So a regular installment sale is an easy way to kind of defer taxes. So so when it comes to installment sale, rather than the bank holding the mortgage, you hold the mortgage, right? So the main benefit of holding the note that secures the property is, at an interest rate, is much higher than you could get from your local financial institution. So you basically, rather than getting your cash all up front, you have the person buy it from you over time under a note that secures the property, that is secured by the property, and you collect interest on that note. So you be the bank rather than let someone else be the bank. And generally, those interest rates are higher than the cash you would get at your financial institution. So in an installment sale, you earn interest on the gross amount. The gross amount, because you have not yet paid the taxes from the installment sales, you will pay the taxes as you get paid. So you get paid as the principal is paid down. Well, rather, I should say, the tax consequence flows according to the principal pay down of the note. So there are two consequences that you can recognize some amount of tax up front. First of it being depreciation that's claimed in excess of straight line. That will be triggered on the front end. And then the second piece would be investment tax credits on low income or certain rehab properties. Those can also, the investment tax credits and excess depreciation over straight line are both recapture potential when you use an installment sale. So that is to say, those pieces are not allowed to be deferred under the installment sale. They get triggered up front, and then the remainder will be, will be taxed according to the principal pay down. You make an installment sale when you dispose of property and then receive at least one payment for that property after the close of the taxable year. So the installment sale treatment is not elective, it's the default treatment. So if you make a sale of an asset and you receive payments across 2 tax years, then you're automatically treated as being on the installment method. So payments you receive under an installment sale come in 3 components. One, there's the taxable part of the principal payment. There's a non-taxable part of the principal payment, basically the basis recovery, and then you've got the interest. And so basically when we do all of this, the consequences is that you basically determine a gross profit percentage based on what did I sell it for, what was my adjusted basis in the asset. Adjusted basis is what you paid for it minus any depreciation deductions. You can add in improvements that you've capitalized and all those sorts of things, and then you subtract off also, and then selling expenses also reduced contribute to your basis in the transaction, so that you then take the proceeds minus those pieces and you get a gross profit. The gross profit percentage will then be that what you expect to profit from the transaction absent interest over the gross proceeds, and that tells you how much of each payment is going to be taxable. So we do a form called a 6252 every year to record this. You keep track of everything. Excuse me, yawns today. And then the most important thing, though, to remember is obviously we're doing this for the benefit, partially because of the benefit of interest, but note the tax law requires that you charge a minimum rate of interest on an installment contract equal to the lower of 9% or the applicable federal rate, which the IRS publishes, monthly. so yeah, it just depends. You just go check the applicable federal rate, the AFR, and you can determine it. To make the most money, your owner, you'll have to look at the highest interest rate that the seller will pay and then add points if possible. So that's really how you get the real kicker out of these transactions. It's not only on the gross sales price, but figure out what's the best rate you can get as the seller to maximize your interest take on the deal. So key takeaways here: whenever you can, avoid an outright taxable cash sale of an investment property, and then to avoid taxes while you build your portfolio of real estate investments, you can use a 1031 exchange. If you want to cash out, move on, and also take care of your estate, you can consider the charitable remainder and wealth replacement trusts. If the trusts are, beyond what you need, you can consider a Section 721 REIT or UPREIT transaction to defer taxes on the disposition of your real estate investment. And it also gives you some liquidity. That's the nice thing there. And then if you don't mind paying taxes, but you'd like those payments spread out over a number of years, you can do the installment sale method. On the installment sale method, I said it's the default treatment. If we have a good reason, we can elect out of the installment sale, but that's obviously something that you do actively. You actively elect out of the installment treatment. If you sell a property and it's going to have payments across 2 separate tax years, it's automatically going to be installment sale. All right, friends, apologies for the yawn today, but if you want to talk about any transactions that that might be of interest to you, or get a perspective, feel free to schedule a call using the link down in the video description, and look forward to giving you another video soon. Talk soon. Take care. Bye-bye.